Don't have depletion, right? That was another one. Okay. Changes in payables and receivables. How often do those happen? Payables. How often do those change? Because generally you're given somewhere between 30 and 90 days, right? Since you're putting these statements out 4 times a year, you're generally having quite a fair amount of turnover in those, right? What about changes in inventory? I mean, there's another line item. How much inventory does Google have? A lot of the accounting-based terms are set up during the industrial economy. Okay? And so you have a lot of jargon and a lot of line items that simply don't apply to the modern information-based economy. Right? Google is unique, but perhaps not for that long, right? I mean, we'll have more and more companies like Google. Okay? So you get your depreciation, your amortization, your change in liabilities, right? Anything else that you might put up there?
Deferred taxes?
Sure. Unless, of course, it was a cash-based system, like you paid the IRS or something like that. Well, investing activities, you got capital expense, and you got investing activities. All right. Now these are cash-based systems. Why would you pull that out on the indirect method? When you're doing a capital expense, you're writing a check to the contractor, right? That's cash. I thought we were just pulling out non-cash items on the cash flow statement. I think I've hit that point at which half the eyes are glazed over. Your eyes are almost closing. The reason is that investing activities don't make it to the income statement, right? So one of the things they were talking about doing on the income statement was trying to break it into operating, investing, and financing portions, right? But if you were to take that $100 million, you're the widget company in Hong Kong, and you're going to make a widget factory, and you're going to take $100 million in cash, and you're going to create a building, it never touches the income statement. It's not an expense. So when you're going from net income, and you're trying to end up with change in cash, you've got to put that in there, even though it is a cash transaction. It is a non-income statement cash transaction. And so therefore you have to add it or subtract it from the net income, right? Investing activities is the same way. But actually only certain types of investing activities. If you're investing cash in something, so you're investing cash into let's say a long-term asset, that would go down there. If you're going from, let's say, treasury bonds to treasury notes, that's a non-cash transaction. Remember, with the cash flow statement, you want to end up with change in cash. So if you're going from one long-term asset to another long-term asset, not going to be there. Financing activities, dividends paid, right? Again, something that you're not going to see. It's a cash transaction, right? But not something you're going to see on the income statement, right? The income statement ends up with net income. Once you have net income, the management has to decide whether or not this is going to sit as cash on the balance sheet or whether or not you're going to give it back to investors. Okay? And the other thing, so the way the management will think about these things, you take the dollar in from the widget sale. You know you have to pay for the widget, right? You know, if you're going to have another sale, you got to sell another widget, right? You always have to pay the salesman, or he'll quit and he won't sell you next widget. The only variables that you have in there is how much you're going to spend on R&D, right? You only spend a certain amount on R&D because there's a technology curve in every sector, right? So you want to spend a certain amount of time developing a better widget, okay? And then you've got your decision about what you end up doing with your remaining money. Whether you're going to put it on the balance sheet or whether you're going to give it back to the shareholder. Now, if you give it back to the shareholder, you should have friendlier shareholders. Your stock price should be higher. And you can always get the cash back by issuing new shares, right? It's not always working that way. And oftentimes it's better to have cash on the balance sheet so you don't have to go through the process of actually doing the financing. All right, this will be the last step into sort of the theoretical portion of accounting. I think it's a good one to have, so let's just bear with me on this. Revenue has a conceptual definition, and I want to go through this with you because, again, we're going to end up today with a case study, which is creating a financial statement, and I'll start that off with you and then leave it for you all to complete as a homework assignment for tonight. But I want to go through this theoretical definition of what revenue is and what expenses are, okay? So I'll read along with me. Revenue is inflows as opposed to money going out of the bank vault. This is money coming into the bank vault. Or other enhancements of assets of an entity, okay? So maybe this is just cleaning the windows on your new $100 million widget factory, right? Okay, or having somebody put tar on the roof to fix a leak. That would be revenue under this definition, right? Because you're enhancing the asset, okay? Or settlements of its liability.
But it needs to be major enough, right?
I'm sorry?
Like cleaning the window will not.
Okay, so maybe that wouldn't reach the threshold of significance. But certainly if somebody said, all right, I'm broke. I know I bought 2 million widgets from you, okay? I don't have the money to pay you. But I tell you what, a long time ago I got this bond from you, right? I bought one of your bonds. How about I just tear this thing up? It's a bearer bond, okay? And I don't have the money to pay you, but why don't I just rip up this bond and we'll call it even? Bond's worth more than $2 million, no problems. That goes down as revenue because it's a settlement of a liability, okay? During a period from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. Okay? What about royalties? Would that constitute revenue?
Depends on what business you're in. I would imagine a record label probably counts royalties.
A record label counts what?
Would count royalties as their central business.
What if the royalty was a technology for making records, as opposed to a new recording by an artist?
I'm not sure.
Generally, they use that pretty broad, okay? But they would not include, for example, interest income from an investment. So if you invested in a bond of another company, okay, and that bond pays 5% per year, you have money going into your bank vault, okay? But that money is not as a result of the entity's ongoing major or central operations. It's just return on a bond that you owe. Okay, so that would not go down as revenue.
With regards to minority interests, do they count the revenue that they make on the percentage of that business, or all of it? Actually, this has been a confusion for me for some time.
I'm confused along with you, but that's something we can look up afterwards. Okay. Usually represented as sales minus sales discounts, returns, and allowances. What are sales discounts? Oh, it's like a coupon, right? Cut it out of the paper, 10% off thrifty towels, sales discounts, right? Returns, somebody buys the widget, returns the widget because the widget's defective, right? Got to take that off of the sales, right? And allowances, generally you have an allowance for bad debt. You have an allowance for lost goods. Oftentimes in retail, you'll have an allowance for stolen items, right? Different stores will have different allowances. You've got a store up in the Bronx, you'll probably have a different one than if you have a store in Tribeca, right? It's just take a look at last year's results, right? Expenses. Expenses would be the inverses, right? Outflows are other using up of assets or incurrence of liabilities during a period of delivering, producing, rendering services, or carrying out other activities that constitute the entity's ongoing major central operations. And here's what they're breaking them up into on expenses. Cost of goods represents the amount a product costs to produce. Pretty straightforward, right? Okay. G&A, which is different from what we're normally used to, which is SG&A, right? G&A is distinct. And it represents expenses to manage the business.